In today's video, I want to show you one of the simplest and most effective trading strategies for beginners that you will ever see. You can apply this strategy in stocks, futures, forex, and cryptocurrencies, and in any time frame you wish to trade. I will show you the techniques involved, how to place stop loss and take profit targets according to the strategy, and how to trigger long and short trades with it. If you're new to this channel, please consider leaving your like and subscribing right now, as this helps support the ongoing creation of free videos like this one. This strategy consists in combining two very well-established trading techniques, the simple channel and the momentum divergence. The simple channel is a form of support and resistance, and the momentum divergence is a way to measure the strength behind price movements. The strategy I'm going to show you today capitalizes on the fact that when we have a momentum divergence while price is hitting a channel line, there's a higher chance that price will reverse, but there are additional details you need to be aware of as well. Let me show you how to draw the simple channel and how to spot the momentum divergence with illustrations, and then we'll move on to the full strategy in real price charts, including where to put the stop and take profit target levels and how to trigger trades. Let's begin with the simple channel first. There are many types of channels you can draw in a price chart, but one of the simplest and easiest ones consists in identifying the angle between two market extremes and then duplicating that angle to the opposite market extreme in the middle. Let's begin with the bullish version first. In the bullish version of the simple channel, the first step is to identify two highs. The second high must be higher than the first one. Next, you connect the two highs in order to form a line with a specific angle. The third step is to duplicate this line to the low in between the two highs you identified earlier. The two lines will form a channel, and sometimes price will respect the boundaries of this channel almost exactly. Let's now see how to draw the bearish version of the simple channel. In the bearish version of the simple channel, the first step is to identify two lows. The second low must be lower than the first one. Next, you connect the two lows in order to form a line with a specific angle. The third step is to duplicate this line to the high in between the two lows you identified earlier. Let's now learn about the other element of the strategy, which is the momentum divergence technique. Divergence is about measuring the strength of price movements by comparing the highs and lows in price with the highs and lows in a window oscillator like a RSI, for example, even though you can find divergence signals in many other technical indicators as well. In this video, we'll focus on the RSI. I will show you two types of divergences, the reversal and the continuation divergence. Let's first look at the bullish version of these two types of divergences. The bullish reversal divergence happens when price is forming lower lows, but the momentum indicator is forming higher lows. That usually means that price is losing strength and might reverse to the upside. When looking for the bullish reversal divergence, you just look at the lows and ignore the highs. The bullish continuation divergence happens when price is forming higher lows, but the momentum indicator is forming lower lows. That usually means that price is gaining strength and might continue to the upside. When looking for bullish continuation divergence, you just look at the lows and ignore the highs. Let's now look at the bearish version of reversal and continuation divergences. The bearish reversal divergence happens when price is forming higher highs, but the momentum indicator is forming lower highs. That usually means that price is losing strength and might reverse to the downside. When looking for a bearish reversal divergence, you just look at the highs and ignore the lows. The bearish continuation divergence happens when price is forming lower highs, but the momentum indicator is forming higher highs. That usually means that price is gaining strength and might continue to the downside. When looking for bearish continuation divergence, you just look at the highs and ignore the lows. Let's now build the channel momentum strategy based on these techniques. As I said before, this strategy is very simple. The buy and sell signals happen when price hits the simple channel line at the same time that a reversal or continuation divergence is happening in the RSI. For a buy signal, price will hit the lower line of the simple channel. Ideally, you want to see price showing some sort of reaction to the channel line, and then you check if the RSI is displaying a bullish reversal or a bullish continuation divergence. The stop loss order can be placed below the candlestick that hits the channel line if this candlestick shows some sort of reaction to the channel line. The stop can also be placed below a previous major low. The target is based on the stop loss size and it must always be 3 times as large as the stop. If all these conditions are met, you can trigger a long position at the open of the next candlestick. You are not supposed to move the stop and target orders when the trade is opened. You either let the market hit the stop or hit the target, otherwise this strategy will not work. For a sell signal, price will hit the upper line of the simple channel. Ideally, you want to see price showing some sort of reaction to the channel line, and then you can check if the RSI is displaying a bearish reversal or a bearish continuation divergence. The stop loss order can be placed above the candlestick that hits the channel line if this candlestick shows some sort of reaction to the channel line. The stop can also be placed above a previous major high. The target is based on the stop loss size, and it must always be 3 times as large as the stop. If all these conditions are met, you can trigger a short position at the open of the next candlestick. You are not supposed to move the stop and target orders when the trade is opened. You either let the market hit the stop or hit the target, otherwise the strategy will not work. Let's now see some real examples of this strategy in different markets and different time frames. The first example happened in the 4-hour chart of Amazon. The first step here is to identify 2 major highs since price is rising. To draw the upper line of the simple channel, we simply connect the 2 highs and then duplicate the same angle to the major low in between the 2 highs. The next step is to let price advance and see if it hits the lower line of the channel. In this chart, we can see that price does hit the lower line of the channel. The additional detail that is important here is how the candlestick that hits the channel line reacts to it. Look how this candlestick has a large lower shadow. That means that price is treating that lower line as a barrier. This is the type of reaction you want to see when the candlestick hits the channel line. The next step here is to look for the momentum divergence. In this chart, it's easy to see the bullish reversal divergence happening. We can identify a lower low in price and a slightly higher low in the RSI. Now we have the green light to pull the trigger in this long trade opportunity, but before that, we need to establish a safe stop loss level and a target. In this case, we put the stop loss right below the candlestick low that hit the lower channel line. The reason for that is that price is clearly finding some buyers in that line, and we want to count on those buyers as protection for our long position. The target will be 3 times as large as the stop loss, so you can have good expectancy. To trigger the long position, you will wait until the open of the very next candle. This next chart summarizes the whole trade setup, the stop and the target. We have price reacting to a lower channel line at the same time that a bullish reversal divergence is happening. The stop loss is logically placed and the target is 3 times as large as the stop, which is necessary if you want to survive trading in the long term. Let's now see the outcome of this trade idea. Here you can see how price starts to rise immediately and it hits the predefined target in about 11 candles. That's a perfect 1-to-3 risk-reward ratio trade using very simple techniques. Let's move on now to an example of a short trade. In this chart, you can see the 15-minute time frame of the British pound versus the US dollar. In this next chart, you can see that I marked 2 main price movements, meaning 2 lows and 1 high in between. The very next step is to draw a simple channel by connecting the 2 lows, and then duplicating the same slope and placing it on the high in between, as you can see in this chart. For this strategy, you want price to come back to the channel line and show some sort of reaction in there along with the momentum divergence. In this other chart, you can see how price comes back to the upper line, and then a candlestick with a large upper shadow appears to imply that price is indeed respecting this line as a barrier. The next step is to analyze what's happening with momentum. In this chart, we have a bearish continuation divergence in the RSI. Price is creating lower highs while the RSI is creating higher highs. All the ingredients for a short trade are present, so now we must decide the stop loss and the target. The stop in this case can be above the candle high that displayed selling pressure, and the target must be at least 3 times the size of the stop. You wait until the open of the very next candle to trigger the trade. Let's see the outcome of this trade idea. Here you can see that price began to go down immediately after the reaction in the simple channel line and easily hit the target. As I said in the beginning, this is a very simple strategy, but it has a challenge like any other good trading strategy, which is the fact that you need to have the patience to only trade when the elements happen at the same time. That is by far the most difficult part about high quality trading, much harder than learning any technique. That's it for this video. If you wish to take your trading skills to the next level, please check out my premium courses in the video description. If you like the content I create and you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button so you don't miss future uploads, share the video, and leave your comment below. Thank you very much for watching, and I hope to see you in the next videos. Take care.